But I would say more broadly for all of the firms, the FDIC and the board identified a range of shortcomings, things that we did not think rose to the level of deficiencies, but nevertheless are things that we want to see corrected. And we will be reviewing the next round of submissions due in 2017 to see if they've been corrected or not. And it's conceivable that if there's been no progress, those things could later rise to the level of deficiencies.
Thank you very much. I yield back.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Chair Yellen, this month the Fed, along with the OCC and the FDIC, put out its required report on bank investment activities required under Section 620 of the Dodd-Frank. The Fed raises several concerns with physical commodity activity of financial holding companies under both the complementary authority and the Section 4040 authority. Last week, the Fed issued a notice of proposed rulemaking whereby it would impose significant capital requirements on covered physical commodity activities that would effectively prohibit many of these activities. In both the documents, the Fed relies on the term environmental catastrophic risk or catastrophic risk. How does the Fed define that risk, and how does the Fed measure it?
Well, the Fed has been motivated in this rulemaking by looking at the enormous environmental consequences of things like oil spills, the BP disaster, and other things, and the kinds of consequences that those can cause financially for firms and also reputationally. And we are concerned and have done a rulemaking on physical commodity activities, as you indicated, that attempt to address the risks that we think exist in that area, and have recommended to Congress repeal of the merchant banking authority for essentially the same set of reasons.
Yeah, but I guess the question is when you're analyzing risk, you go back and you look at past activities to determine do I hedge my risk against that? I guess the question is what past environmental catastrophes have posed a problem for financial holding companies. So can you point to something that say, gosh, if that happens again, there's a problem? I can't think of an event that happened that impacted those financial holding companies.
Well, under the merchant banking authority.
But this is a different, there are two different authorities here, the merchant banking and then them being able to hold the commodities. I want to specifically talk about the commodities.
Well, we look at what's permissible and see that there could be environmental risks associated with it. It's not a question of just going back through history to see what has happened in the past. It's a forward-looking concern that the permissible activities could pose risks.
I'm a little afraid that we're just trying to think of things that could happen and then trying to make all of these financial institutions, somehow pay a punitive penalty in either capital or regulation for events that we may not have happened and may never happen again. I want to then turn to the GSIB surcharge and stress test. Some commentators have stated that the GSIB surcharge effectively works as a tax on capital market activities. Can you kind of name the components that make up the surcharge and what activities tend to increase the score?
There are a set of factors that are considered in determining the GSIB surcharge, including things like interconnectedness and reliance on short-term wholesale funding, factors that would increase the likely systemic repercussions of the failure of a firm. And as you said, the GSIB surcharges can be thought of as taxes imposed on these firms that serve two purposes. First, they, by insisting that firms hold more capital to address the risks that their failure could impose on society, on the broader economy, they ought to be less liable to fail, and holding more capital accomplishes that. And it may create an incentive for these firms to restructure their activities in a way to...
So when you look at that, for example, complexity is one of those. That, I think, talks about the size of the bank's asset that's involved in market making, and then interconnectedness components, primarily dealer-to-dealer trading assets used to for hedging and market making activity, and then cross-jurisdiction components of dealer-to-dealer trading similar to the interconnectedness factor. And when you start to look at all of those things that you're penalizing those entities for, it's making markets in the capital markets. And I think what many of us are concerned about is the message to the banks right now is just get out of the capital markets area, because the regulators are making it very punitive to be in those activities.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you, Mr. Chairman. I believe that Chair Yellen's performance so far has been nonpartisan, admirable, and has proven that she is more than capable of navigating these difficult waters and guiding the U.S. economy back to robust economic growth. So I am disturbed by anyone in a recent debate or anywhere who suggests that Chair Yellen is somehow acting politically. Nothing could be further from the truth, and I would like to thank you for the service to our country over your long career in government. And I would like to begin with a question on monetary policy before we get to regulation. You said last week at the FOMC meeting that one of the reasons the Fed didn't raise rates was because more people had come back into the labor force without the unemployment rate going down, which suggested to you that the economy, and I quote, had a little more room to run, end quote. But you also said that if things stay on the current course, you expect one increase in interest rates before the end of this year. So what does that mean? Does that mean that you expect the unemployment rate to start falling again soon? So in other words, does this mean that you think that the economy has a little more room to run, but not that much room to run? Exactly what did you mean?
So let me try to clarify. For this entire year, job creation has been running at a pace of about 180,000 jobs per month. And that is a pace, it's a little bit less than we saw in 2015, but nevertheless well above the pace of job creation that's sustainable over the longer run given trends in the labor force. Now, I've been pleasantly surprised to see that the unemployment rate actually, as I mentioned, hasn't fallen over that time because people have been drawn back into the labor force, and that's really means, and with inflation running below 2%, we're really not seeing meaningful upward pressure on inflation, and we haven't seen the unemployment rate fall. But monetary policy is accommodative. Eventually, continued job creation at that pace would cause the economy to overheat and would push the unemployment rate down to lower levels than now. So monetary policy is accommodative. We want to make sure that the expansion is one and the good performance of the job market is sustainable over the medium term. If we allow the economy to overheat, we could be faced with having to raise interest rates more rapidly than we would want, which could conceivably jeopardize that good state of affairs that we have come close to achieving. So we expect to see the unemployment rate fall farther. We expect to see solid job growth continue, but we do need if things continue on their current course, to gradually remove the accommodation that is there. Now, it's probably not that much. Our estimate of how much accommodation there is has come down over time as economists have reconsidered what is a neutral stance of policy. But nevertheless, there is accommodation. And while there's no fixed timetable for removing it, many of my colleagues indicated in their recent projections, the majority, that they would see it as appropriate to make a move, to take a step in that direction this year if things continue on the current path and no significant new risks arise.
Thank you. Now I'd like to ask you about the stress tests also. Some people have argued recently that the Fed should put the economic scenarios it develops for the stress tests out for formal notice and comment for the public and for interested parties in order to let industry and others weigh in on the assumptions that you use. And of course, the fact that the Fed can tweak these scenarios every year to account for new market developments is one of the main reasons why I would say they're useful. So could you respond to that quickly? My time
Very
is up.
briefly, please.
Just very briefly, we want to make sure that those scenarios are based on timely information and address the most significant risks we see. We have put out for comment both the principles underlying our stress tests and information about how we construct the scenarios so firms have quite a good idea of what they can expect in terms of a scenario that they'll face, but all the details we don't put out for comment. It would
The time of the
involve
gentlelady from
large delays.
time of the gentlelady
Thank you
from
very
New
much.
York has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of our Capital Markets Subcommittee.
I thank the chairman. Thanks, Chair Yellen. As you know, last week there was the big FOMC meeting, and surprise, to no surprise, the Fed decided to do what? To continue the extraordinary accommodative monetary policy. Now, I know you have taken the position that the Fed's position are all purely data-driven, and that's where some of the questions were before, and that has absolutely nothing to do with politics. But you know, less and less people really do believe that. Let me just give you two or three headlines out of last week regarding the FOMC meeting. From Politico, from right around here. Yellen helps Clinton dodge a bullet. From the LA Times. Is the Fed politically biased? Well, look at its interest rate decisions as the election nears. From Market Watch. A Fed rate hike and other important decisions, again, being put off until after the election. See, Chair Yellen, you have told our committee and the public on countless occasions that the Fed is not subject to undue political pressure. But as the saying goes, perception is reality. And whether you like it or not, the public increasingly believes that the Fed independence is nothing more than a myth. And the Fed has an unacceptable, cozy relationship both with the Obama administration and with higher-ups in the Democratic Party. Now, I brought this up a year ago, and let me run through some of those points that I raised then. You personally have weekly lunches with political and partisan heads over at the Department of Treasury. There is, in fact, a revolving door between the Treasury appointees and the Board of Governors. Your predecessor, Chairman Bernanke, had made a decision literally just weeks before the president had to go before the voters in 2012. And looking at your record, your speech on income inequality, something you never talked about before, but which became a major political theme for the administration, and you gave it just weeks before that last election. Now let me give you one most recent one, and maybe you can just comment on this in a couple of yes and no's. There's little doubt about last week's FOMC meeting that potential implications for the markets and therefore the election. But it was reported earlier this year that Fed Governor Lael Brainerd contributed the maximum amount to the Hillary Clinton campaign. And she did so while she was a sitting member of the Fed board. And there was numerous reports that have come out, media reports, stating that the governor is angling for a top job with the Clinton administration if Hillary wins. So some basic questions, knowing that's all out there on the table. Because of the appearance of conflict and impropriety there, has Governor Brainerd ever offered to recuse herself from voting at the FOMC? Has she?
Governor Brainerd, like all of us, is subject to the restrictions of the Hatch Act.
Right, so has she offered to recuse herself because of
No.
her political involvement? The answer is no? Have you ever asked the I'm sorry.
The Hatch Act does not prohibit political contributions.
I get that, and so, but we
And-
see the appearance of the conflict, and so it's a basic question. Has Governor Brainerd ever offered to recuse herself? And the answer is no. Have you ever asked Governor Brainerd to recuse herself because of her close involvement with the campaign in making contributions? Have you ever
she's-
asked?
She's acting in a way that is permitted by the rules
So your
that
answer
we're
is-
subject to.
Right,
And
so
each one of us has to
I
decide
understand that. So the
for
answer is,
ourselves.
the answer is she has never offered to recuse herself. The answer is you have never asked her to recuse herself. To your knowledge, has Governor Brainerd been in contact with the Clinton administration, or Clinton campaign, regarding a potential job in a potential future administration? Are you aware of that at all?
I have absolutely no awareness of that.
There have been published media reports talking about that, so you're not familiar with those media reports.
What's important to me is whether or not in our decision-making, our collective decision-making, I see politics being brought to bear in reasoning about our decisions. And I have never seen that on the part of any of my colleagues.
If you learn that she has had communications with Clinton as far as trying to get a job, would that change your opinion as to whether she should be asked to recuse herself?
I don't think that there is a conflict of interest there.
So a federal governor can be in direct negotiations with a political campaign looking for a future job, and that is not a conflict as far as you're concerned.
We do have.
No, is that a conflict or not? If they are having direct negotiations with either political party to ask for a job next year while they're a sitting governor, do you see that as a conflict?
Will the gentleman yield?
I would like
no
to
time.
know. I would like to have an answer. Is that a conflict?
Will the
And if it is a
gentleman
conflict,
yield?
will you be asking the governors whether they are engaged in such activity?
Will the
The time
gentleman
that
yield?
the gentleman apparently is not yielding. The time of the gentleman has expired. Can the witness give a brief answer?
I would have to consult my counsel. I'm not aware that that's a conflict, but I would.
The time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Chair Yellen, Puerto Rico is currently facing a historic crisis. 46% of the population lives below the poverty line, 3 times that of the U.S. mainland. Employment in Puerto Rico stands at roughly 1 million, down nearly 300,000 from 2007. In the meantime, the U.S. economy has gained almost 10 million jobs in the same time frame. On top of these challenges, the island is struggling with Zika virus, and last week, a blackout swept the island. When the U.S. mainland faced severe challenges from 2007-2009, Congress passed and the President signed sweeping stimulus legislation, the American Recovery and Reinvestment Act. Do you believe that this legislation was helpful in fostering an economic recovery for the U.S.?
Well, I do think Puerto Rico faces very serious economic and fiscal problems, as you have described. They have been building for a long time, and the Commonwealth faces very significant challenges. I think the framework that Congress passed provides tools that maybe enable the Commonwealth to avert some worst-case scenarios, the ability to restructure debt should make it possible to put in place a fiscal adjustment that will be one that's less uncertain and hopefully entail smaller cuts to government spending.
I
this is
understand all that, Chair Yellen. It will take time for the Fiscal Control Board to do its work, and the situation in Puerto Rico is really very difficult at this time. My question to you is, how can we spur investment in Puerto Rico, how can we foster economic growth and not wait for the Fiscal Control Board? Because the reality is people are leaving the island. The most productive workforce is leaving the island. They're facing serious problems with a healthcare system that is broken. And my question to you is, do you believe that a Puerto Rico-focused stimulus plan will have similar effect on the island's economy like we did here in 2008, 2009?
So this is really something, I'm not an expert on what the appropriate programs are for Puerto Rico to deal with its longstanding problems, and I think that's squarely a matter for Congress and the administration to consider.
Okay, thank you for that answer. We cannot forget that Puerto Rico is part of the United States, that we have a responsibility, a moral obligation. After all, we don't provide priority in some of the important issues that they're facing, such as Medicaid and Medicare. Chair Yellen, last Friday, the Federal Reserve Bank of Philadelphia launched a research and advocacy initiative to examine the interaction between economic inequality in the U.S. and its implication for macroeconomic prosperity and growth. What is the Fed hoping to learn from this initiative, and how is the Fed hoping its findings will further the economic inequality discussion?
So
I don't see it as a political plot. I see it as a contribution in terms of, promoting economic growth among those who have been left behind.
yes, I think the high level of poverty and inequality in the United States is a concern, should be a concern to all Americans, and an important challenge that our nation hopefully will address. And this initiative is really focused on trying to understand what some of the key factors are that are driving those outcomes, and looking at practice to see, based on real-world experiences with programs that are attempting to address poverty, what works and what lessons can be learned that might be of use to communities trying to deal with entrenched poverty.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Luca Meyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and Chair Yellen, welcome. We spoke a lot about the sheer volume of rules coming out of the Federal Reserve. It's rule after rule, layer of regulation after layer of regulation, and that's really impacting financial institutions across this country, whether they serve a small community in Missouri or customers across the globe. Now we have the merchant banking and physical commodities involvement by the Fed, as my colleague, Mr. Nagelbauer, has indicated. And I hope that you work with this body with regards to those rules. Fed officials have made statements to the effect that the benefits of merchant banking outweigh the potential risks, yet we seem to be intent on trying to find a solution for there is no problem. That concerns me greatly, and I can assure you we intend to have a number of questions, written questions for you to respond to with regards to that issue. Today, though, I want to discuss the SIFI designation stuff that Mr. Tarullo announced this past week. I think it's important. We suddenly now recognize that the SIFIs should be designated based on risk, not just on size. That's an important thing. Secretary Liu was here last week, made that same comment, basically, that we need to look at other factors other than size, and that seems to be your position as well now. With regards to that, can you tell me what administrative costs will be incurred by the Fed to remove the CCAR requirement?
I'm sorry.
Can you tell me what the costs by the Fed would be to remove the CCAR requirement of being a SIFI, the stress test?
Well, we believe that stress tests are a very important way.
I'm not talking about whether you do or do not do them. What is the cost that you're going, what's the savings that you're going to have, or is there a cost to de-designate? Is there a cost to administratively remove the CCAR requirement? Is there a cost to do that?
Is there a cost in terms of dollars and cents that we spend
right.
on it?
Does the Fed have to is it cost you something to administratively remove the CCAR designate,
Does it cost
requirement.
us to implement it and to run the tests? And would we, are you asking me,
I'm asking you to remove the requirement, does it cost you money?
does it cost us money to remove the requirement? It does
Yeah.
not.
Yeah, the CCAR requirement, does it cost you money to do that?
Does it cost us money? No.
Okay, that's what
But
I
I
want to know.
think it would be a cost in terms of safety and soundness. I think this
No, I'm not
is a-
talking about, I'm talking about the Fed. Does it cost you money to remove the CCAR requirement? You said no. That's what I need, and that's the answer to my
Well,
question.
any cost also that we incur in carrying out CCAR in the stress testing is passed on to those institutions who pay for the cost of their supervision.
Okay. Last February, the Office of Financial Research conducted analysis of the systemic importance of 33 U.S. bank holding companies based on basically the tenets of my bill, H.R. 1309. And given that all this work has been done, can you tell me what you think the cost would be for FSOC to de-designate and redesignate a financial institution?
For FSOC to what?
For FSOC to de-designate or redesignate these institutions if they are no longer SIFIs, according to the bill. I have a bill that says you have to look at these things, and if it shows that the institutions are not SIFIs, you have to de-designate them, and they redesignate them if they are, just to analyze them. Is there a cost to that?
Well, yes, I think it's clear that these institutions...
Can you give me a figure?
No, I cannot give you a figure.
Okay. Can you give me a ballpark? Is it $100, $1,000, $1 million, $10 million?
I can't give you
Okay.
an estimate.
Well, the problem is that the FSOC staff, which includes the Federal Reserve, informed the CBO that the de-designation and potential redesignation of banks costs, there were over $50 billion in assets, would have an administrative cost of